9,000 crore rupees. Gone. A global airline brand reduced to unpaid bills and grounded planes. A smiling icon on billboards. A city full of angry creditors. How did one man's sparkle hide a collapsing business? In the next hour, we'll follow the money, the marketing, and the moment the mask slipped. Listen close. For a long time, the world saw a brand first. Kingfisher meant blue uniforms, pop music in airport lounges, and a billionaire who lived as if money were a prop. It was a feel-good story, a family empire, a beer that sold itself, and an airline designed to feel like a flying lounge. But underneath that veneer was a different story, one of stretched forecasts, repeated loan requests, and corporate moves that, when examined closely, didn't match the glamour. Let's rewind to the early years. Vijay Mallya came from a family embedded in India's industrial fabric. The family business, United Breweries, produced Kingfisher beer, an unmistakable mass-market brand. In 2005, Mallya launched Kingfisher Airlines, promising a full-service premium carrier that would redefine air travel in India. The pitch was elegant. Premium cabins, global routes, celebrity-backed advertising, and a lifestyle people wanted to buy into. Banks heard that pitch. Lenders watched a brand that filled planes, promoted loyalty, and drew headlines. Projections looked optimistic. Passenger growth, higher yields, expansion into international routes. Mallya asked for money to buy planes, lease aircraft, and fund rapid route expansion. The loans followed. Aircraft were ordered. Staff were hired. The airline painted airports with its color. But the airline industry is unforgiving. Fuel prices spiked. Competition from low-cost carriers cut into market share. Regulatory fees and taxes kept margins thin. Kingfisher's cost base ballooned. Planes were expensive to operate and to park. The cash needed to keep the operation running outpaced ticket revenues. Service standards remained ambitious while the balance sheets diverged from those glossy advertisements. By the time the first public cracks appeared, the business had already accumulated substantial debt. Loans taken to finance Kingfisher Airlines, large successive rounds, were supposed to be repaid by the airline's future profits. Instead, those profits never materialized at the scale projected. The defaults added up. Ultimately, lenders were left staring at unpaid obligations totaling more than Rs 9,000 crore. The numbers alone read like a reckoning. But numbers don't tell the whole story. The deeper issue was how perception became a currency. Mallya's personal brand, his jet-set lifestyle, high-profile parties, sporting sponsorships, and visibility in international social circles was not accidental. It reinforced the message that Kingfisher was a success story. Sponsorships of cricket teams and lavish advertising campaigns did more than sell beer. They sold confidence. That confidence mattered when banks were evaluating risk. This is the branding trap. When charisma substitutes for transparency, when brand momentum is used to justify aggressive forecasts, and when lenders begin to lend to the image rather than to the underlying economics. As operational red flags accumulated, cash squeezes, delayed salaries, grounded planes, the company kept trotting out assurances. We're reorganizing. We're in talks with creditors. We'll be back. Those lines can comfort employees and investors in the short term. But if the underlying operations are deteriorating, assurances become postpone and patch measures. Air tickets sold today couldn't cure deferred maintenance bills or satisfy lessors asking for unpaid lease rentals. Then came forensic scrutiny. Banks, bruised and uncertain, demanded answers. Forensic audits and bank inquiries pulled at threads that had once been glossed over. Paper trails exposed major financial irregularities tied to loans and to business transfers connected with airline operations. Intercompany movements, related party transactions, and restructured accounts raised questions that went beyond poor management. Some funds earmarked for operations were moved in ways auditors found troubling. Where money had been expected to flow into maintenance, fuel, and crew costs, flows were rerouted. Auditors cataloged inconsistencies. Files were flagged. The story on paper looked very different from the story in the glossy ads. As investigators dug, creditors' patience thinned. Legal notices piled up. Suppliers stopped delivering. Employees who once wore Kingfisher uniforms with pride found themselves waiting in queues for unpaid wages. Pilots and cabin crews faced pay uncertainty. Airports saw Kingfisher planes grounded mid-season. Passengers waited in airports as flights were canceled or delayed. For a national cheering crowd that had once associated the brand with aspiration and leisure, the reality of empty gates and unpaid staff felt like betrayal. Pressure mounted. Regulators began asking questions. The narrative in public shifted. Gone was the easy charm. In its place was a ledger of missed payments and escalating legal disputes. In 2016, as regulatory investigations intensified, Mallya relocated to the United Kingdom. Reports marked that move as the moment the corporate exile became a human one, someone stepping away from the center of the storm. There's a human element at every turn. Think about the bank clerk who signs off on a loan because the spreadsheets look good and the brand is influential. Think about a junior executive reassured by a celebrity endorsement. Think about a mechanic who sees the airline's planes and assumes its future is secure. These are real people, and their lives were disrupted when the financial narrative shifted from hopeful to dire. Why did the branding work so effectively? 3 reasons stand out. First, visibility equals credibility. When a brand occupies billboards, television spots, and sports stadiums, it becomes part of the public imagination. Banks and investors are not immune to that signal. They use it as one data point among many. If customers are buying tickets and the brand is everywhere, underwriters mentally adjust risk assessments downward. Second, forecasting optimism builds momentum. The airline presented growth narratives, new routes, a premium customer base, ancillary revenue opportunities. Lenders, enticed by those forecasts, often structured deals assuming future optimization. When forecasts are aggressive, the immediate need for capital looks like a bridge to a better future. If that future fails to materialize, the bridge collapses under its own weight. Third, corporate complexity can obscure accountability. Related entities, transfer pricing, and intercompany loans can make it hard for outsiders to determine who owes what. If funds move across subsidiaries, the reality of where obligations sit can be murky. Forensic auditors later exposed those pathways. But before the audits, complexity served as camouflage. What does this mean for a system of lenders and corporate borrowers? It means the human psychology of branding can distort rational decision-making. Lending committees are not immune to glamour. Packaged well, a brand narrative can override stubbornly negative unit economics. The Kingfisher case became a learning point. Banks needed better cross-checks, stress tests, and governance scrutiny when public image and financial fundamentals diverged. Let's not lose sight of the operational details. Aircraft are capital-intensive assets. Fuel price volatility, currency swings for leasing and maintenance payment, and regulatory runway fees all created an unforgiving cash flow environment. Airline margins are thin even in stable conditions. Kingfisher's premium positioning increased variable costs, better food, larger cabins, more staff, but didn't reliably increase yields as projected. At the same time, the airline carried the fixed cost burden of aircraft leases and loans. When passenger demand underperformed, leverage magnified losses. When numbers turned, creditors tried to recover. Collections efforts, restructuring plans, and legal claims followed. The consortium of lenders that had financed Kingfisher faced heavy write-offs. In many cases, lenders eventually categorized loans as non-performing assets. Those NPAs rippled into the banking sector, tightening credit conditions elsewhere. The fallout touched not just investors at the top, but small depositors and businesses connected to that flow of credit. Yet the narrative remains double-edged. There were moments of genuine enterprise and a team of people who believed. The early flights were praised for service. The marketing campaigns truly captivated a segment of consumers. The puzzle was timing. The brand promise aligned with a brief window of capital availability. When market conditions turned and the underlying economics didn't adapt quickly enough, brand alone could not bridge the gap. Midway through this story, a small request. If you're finding this thread compelling and want to keep listening to deep financial histories like this one, please consider subscribing. It helps keep these investigations coming, and it's the quiet support that lets us dive into the details. Back to the paper trail. Forensic audits are methodical and slow. They match invoices against bank transfers, check corporate board minutes, and search for related party agreements. In Kingfisher's case, auditors found transfers and reorganizations that raised red flags. Some assets tied to revenue streams were shifted. Certain payments didn't match operational needs. This is not just about accounting errors, it's about governance. Who approved the moves? Were board members fully informed? Were lenders aware of the collateral position? These are the exact questions auditors ask, and in many cases the answers were incomplete. As public scrutiny intensified, the optics changed. Once admired sponsors faced reputational questions. Sports teams began to find missing payments. Vendors who had grown reliant on Kingfisher's business began to diversify or cut ties. Employees who had once been proud of the uniforms petitioned for wages from courts and labor tribunals. Airports saw their gate schedules change. Travelers noticed the difference between an airline that felt like a luxury and one that could no longer guarantee the comforts it promised. The relocation in 2016 added another layer. A founder stepping away during a crisis gives many investors pause. Some see it as self-preservation. Others see it as strategic. For lenders trying to recover assets, extradition and jurisdictional hurdles complicate efforts. The move didn't erase the debt, it changed the terrain of legal action. It shifted battles to international courts, to treaties, and to long, costly proceedings. We return to a larger theme. Symbolism versus substance. A vibrant brand can catalyze growth. It can also mask systemic operational deficiencies if unchecked. The Kingfisher saga shows how branding can be weaponized to attract capital even when the underlying unit economics are fragile. It also shows how bank processes and corporate governance failures can convert a brand's sparkle into systemic risk. There are lessons for multiple actors. For corporate leaders, the takeaway is governance and humility. No brand, however powerful, should substitute for rigorous cash flow planning. For lenders, the lesson is to interrogate assumptions more deeply. Look past the billboard. Stress test against plausible downside scenarios. For regulators and auditors, the message is vigilance. Related party transactions and rapid capital draws need clearer disclosure and faster red flags. We should also touch on the human cost. Executives lost reputations and, in some cases, freedom. Employees lost jobs and livelihoods. Creditors lost capital that could have supported other investments. Public trust in institutions eroded a little. Behind the corporate jargon and forensic charts are people whose lives were altered. And yet, when you walk past an old Kingfisher plane in a hangar or see a brand ad from those years, it's easy to remember why people bought into the dream. The marketing worked. The cabins were comfortable. The music and the color palette created an emotional connection. That emotional connection is powerful. It's also fragile when it isn't anchored to sustainable economics. Near the end, the emotional intensity rises for a reason. This is not just a business failure, it's a cautionary tale about modern capitalism's appetite for narratives. In an era where celebrity founders and charismatic CEOs dominate headlines, institutions must remember that charisma does not equal collateral. Investors must balance optimism with skepticism. Brands must not be allowed to be a smokescreen for governance lapses. What does that look like in practice? It means stronger due diligence on complex group structures. It means independent board oversight with true powers of inquiry. It means banks building teams that can translate marketing narratives into stress-tested numbers. It means auditors who are empowered to escalate findings swiftly, not months later when recovery becomes far harder. Finally, ask a simple question. When does aspiration become a distraction? We admire moonshot ideas and large-scale branding because they promise transformation. But aspiration without adaptability becomes brittle. Brands that cannot flex their cost structures or align their corporate controls to growth will eventually face the consequences, however glamorous the runway appears. The King of Debt is more than a headline. It's a study in how identity, personal and corporate, can shape capital flows, for better and for worse. It shows how familiarity can breed false comfort, and how financial architecture needs to be built with a clear eye for both story and substance. If you followed this tale to the end, thanks for listening. We'll keep bringing stories like this, cases where money, brand, and human decisions collide. If you appreciated this deep dive, leave a comment below or subscribe for more. It's a small way to keep these conversations alive. Close your eyes if you like, and imagine the empty gate where once a blue plane waited. Think of the people who kept it aloft, the mechanics, the flight attendants, the controllers, and the invisible ledger that ultimately grounded it. There are lessons in that quiet space about pride, perception, and prudence. This story ends not with a single verdict, but with an invitation to look harder, to question charm with skepticism, and to value governance as much as glamour. Brands will continue to shine. Systems that let shine replace scrutiny must change. Only then can bright ideas truly earn the runway they take.